Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. Today, I've got with me Logan DeGrave, one of our certified financial planners. We're going to be going through what's happening in the market, all the volatility, how many of the stocks in the S&P 500 are actually in bearish mode right now versus bullish mode versus neutral mode. And we're going to explore that in the Dow Jones Industrial Average as well as the NASDAQ. There's a lot happening with Russia and Ukraine, with inflation and interest rates. We're going to tackle that right now. Before we get to the discussion with Logan DeGrave about how you're going to deal with this in your plan, let's go over some of the most recent data. And the date that Logan and I are producing this is the 23rd. So you're going to get it a little bit after this. Who knows what's going to happen over the next several days because we've got a lot of volatility going on out there. But let's go over some statistics of the major indexes so far year to date. And as you know, we use a platform that shows us whether or not stocks are in a bearish mode, a neutral mode, or a bullish mode. And so I'm going to go over a few statistics with you here. We're not going to get into too deep of the weeds, but absolutely your advisor would be able to do that with you. So what you're seeing here on this chart is that virtually every single major index is either neutral or neutral plus. We don't have anything in bearish territory yet. But let's look at the NASDAQ 100 composite. It is the worst performing composite year to date, negative 15.02%. And out of the 100 stocks in the NASDAQ, 20 of those are now considered bearish, 70 are considered neutral, and 8 are considered positive. So that gives us a neutral rating for the NASDAQ. Let's go down and compare that to the Dow Jones Industrial Average. It's 30 stocks. 3 of those are bearish, 22 are neutral, and 5 are positive. That gives the Dow Jones Industrial Average a neutral plus rating, and the S&P 500 equal weight has 61 negative stocks or bearish, 355 that are neutral, and 82 that are bullish. We don't need to go into all the detail on these, but suffice it to say that we are watching this very, very close to make sure that if more and more stocks continue to turn bearish, and if those indices actually do turn bearish, that's going to be our catalyst to say, hey, maybe it's time to take a little bit of risk off the table. And as we begin this discussion with Logan DeGrave, one of our certified financial planners here at Barber Financial Group, that's exactly what we're going to talk about. Logan, we finished 2021 with a bang. It was an amazing year coming off the heels of an amazing bull run coming out of COVID-19. People were euphoric. It felt great. And all of a sudden, we've had nothing but huge swings in the market, a lot of volatility, and emotions are running high.
Absolutely, Dean. I think people forgot that the market can go down too. You know, we had a lot of conversations with our clients in the fourth quarter last year of, hey, let's take some gain off the table. Oh, I don't want to be in bonds, right? Bonds aren't any good. And well, that's not true. But what we need to worry about here, though, is no one should be surprised, right? Fed's going to raise rates, inflation's up. Those are not the surprising things. The Russia-Ukraine thing, okay, that's a wrinkle in all this. But at the end of the day, the most important thing you can do is talk with your advisor and sit down, look at your allocation, and how does it complement the overall financial plan? How much risk should you be taking on your money? And it may have changed over the last couple of years because, hey, we had good returns. So maybe you don't need to be in that 60-40 portfolio. Maybe you can be in a 40-60 portfolio now.
And Logan, I think one of the things that tends to happen is when you get into a period where everything's great, and the kind of the story is the rising tide lifts all boats. It does feel good, and it's hard to step back from that. But I think what you're saying is when we examine a financial plan and somebody is, I'm going to use your example, the 60-40 portfolio, we may see that their probability of success could be just as strong if we reverse those numbers and had 40% in equities and 60% in fixed income, or maybe it's even 30% in equities and 70% in fixed income. And that's the beautiful thing about having that financial plan done, is being able to go in and say, in a period like this, where there's uncertainty, where there's volatility, what is the least amount of risk I can take on my portfolio and still make sure that I'm accomplishing my objectives?
Absolutely, Dean. I had a conversation with a client yesterday about this. They called, they were nervous about everything going on, pulled up the plan, and just take the emotion out of it. Let the plan do the talking. And in addition, all the money in the portfolio should not be behaving the same way. The money you're spending today and tomorrow and next year and then in the next year, that should be a lot different than the money that we're going to spend 15, 20 years from now. So, that longer term money, hey, it's all right. We know the market will be back, but the money you're spending today and tomorrow, the fluctuations we're seeing right now, you don't want that.
Right. If you go back from a historical perspective and you think about somebody that's in retirement, and it was interesting because I had a conversation. Why would I want to be in bonds? Same thing, right? We're going to have rising interest rate environment. It's not going to be positive for bonds. Well, first of all, not all bonds are created equal, and there are some bonds and some types of investments in fixed income that are actually doing well this year compared to like the bond aggregate. But the bottom line is, you have that fixed income or that safe position within the portfolio for times like this. If the equity piece is down a little bit, you don't want to sell out that equity piece when it's down. What you'd rather do is take some of the fixed income and spend that if you needed an extra lump sum or something like that. And that's what you're saying is make sure that you got enough money in that position that's not going to have the volatility of the stock market so that you can continue to do the things that you want to do and spend the way that you want to spend.
And I don't think I can emphasize it anymore. Make sure all the money in the portfolio is not behaving the same way.
Let's get into a little bit of a discussion about what's really going on with the market and why it's behaving the way that it is. You mentioned the Russia-Ukraine thing, and my opinion on that, Logan, is that I think the Russia-Ukraine thing is a additional catalyst that is scaring the market. We could see oil costs in the $130, $140, $150 bill. We've seen that before, right? Well, what does that do automatically? It creates more inflation on top of an already heightened inflationary environment, which could cause Federal Reserve Chairman Jerome Powell to act even faster, to raise rates faster than what he would plan before, and then the Russia-Ukraine thing dissipates, inflation starts to fall, and the Fed overdid it. And now he sends us into a recession. In my mind, that's where the fear in the market's coming from today. It's all of that uncertainty that is out there. But otherwise, from an earnings standpoint, things look great. From an economic standpoint, it looks good, right? So this is one of those things where if we were just going to look at fundamentals, we could say, wow, things are looking really pretty positive. But you have all of these things that are really out of the control of the market that could have a big time impact in the short term.
Absolutely. You can go back to Bud and I's radio show last week. Was all about the Fed and raising rates and inflation. And none of this should be a surprise, right, to anyone, that what we're seeing. But to your point, you make a great point. The Russia-Ukraine thing does put a wrench in it. And I wouldn't want to be Jerome Powell right now, would you?
No, no. Yeah, I think a few weeks ago when Bud and I were talking about the rates, we're saying that, Jerome Powell's walking a tightrope right now. And, one little mistake could be, could be all it takes to send the markets into a tailspin. So I think the big takeaway here is while we have all this uncertainty is to go back to the asset allocation in the plan and ask the question, what's the least amount of risk I could be taking right now and still accomplish my objectives? Because the sun's going to come out again. We're going to have another bull market, and it's going to feel good. And at that point in time, that's when we can ratchet back up the equity exposure.
I mean, the way I think about this and what I've been talking to clients about is there's always going to be something going on. I mean, think about the last 2-3 years.
Right.
COVID, everything else. There's always something going on. So if we wanted to sit and and I think the better takeaway is don't make knee-jerk reactions here. Okay? Make sure you have a conversation with your advisor. Make sure you're complementing the financial plan, and make sure the two are in sync. Because ultimately, what you don't want to do is watch the news, because you could watch the news on any given day and say, "Oh my goodness, we got to get out of the market." Right? So just have some discipline around the decisions being made.
Well, and as a certified financial planner, Logan, that's exactly what you bring to the table, right? It's let's look at this from a logical standpoint, remove the emotion, and because the idea is we want to make sure that people can live their one best financial life and do the things that they really want to do.
I make this comment all the time. I have no idea what the market's going to do, but what I do know is, Mr. and Mrs. Smith, you're going to need X dollars every month in retirement. That's what I do know. So how do we make sure that happens?
And that's the key. Logan, thanks for taking time to join me here with the monthly economic update. I appreciate it. Ladies and gentlemen, thanks for joining us here. If you're watching us on YouTube, make sure and subscribe to the YouTube channel and give us a thumbs up. If you got questions, obviously reach out, schedule something, We can do a quick phone conversation, a Zoom meeting. If you want to come in the office, we can do that as well. Wish all of you the best, and come on, spring, let's get here quick.